the last point you brought up was in terms of insurance policies. It's kind of the same. It's the same idea. You're assuming that there's a rule of law. You're assuming that this economic paradigm is going to continue to persist in this mathematically impossible paradigm that it is now in. Understand that the insurance companies are one of the biggest players in these derivatives markets. They are the ones who are trading credit default swaps. They are the ones who are trading repos and reverse repos and all of these derivatives of derivatives of derivatives of derivatives. Who is buying up and trading these derivatives of, say, for example, European sovereign debt paper? It's insurance companies, because the way insurance companies make their money is that they're sitting on the premium base that they collect from people for these insurance policies. They take that money, and what they did previously is they invested it in all of these various interest-bearing products, which before could have been relatively low-risk paper, for example, like U.S. Treasury paper, which was considered the safest paper in the world. It was as close to zero risk as you could get. Okay, as soon as the Obama usurpation and installation takes place in 2009, the interest rate is synthetically, forcibly suppressed all the way down to zero. Insurance companies and other entities like brokerage firms like MF Global, who were using the interest markets in order to generate their income, that all disappeared because now interest rates are at zero. So what they had to do, and I put the word had in quotes, nobody has to do any of this, but what they had to do in order to replace the lost interest income from the loss of the U.S. paper market and just the general interest rate market in general is that they had to start going into ever more riskier derivative products. And so they'd start making derivatives of, let's say, for example, Spanish sovereign debt. Okay, then all of the margin was driven out of that. So then someone else would go in and make a derivative of the Spanish sovereign debt market. And then that margin would be driven out. And we're now to the point where we're 6 or 7 derivative iterations into these markets where they just keep, it's like they just keep digging sub-basement after sub-basement after sub-basement. And eventually, and what you realize then is when you're now 6 or 7 sub-basements deep under a structure, there's nothing solid underneath the structure itself. It's all been hollowed out and tunneled out by these derivatives markets. That's what these insurance companies are trading. So let's say you're 50 years old and you've got some life insurance policy that you've been paying into. Let's say it's a $500,000 life insurance policy. It has a liquidation value right now of, let's call it $70,000 or something like that. You're 50 years old. Odds are that if you don't die in this counter-revolutionary world war that's going to happen, if you don't die in that, if you live to natural old age, you've got another, 25, 35 years in front of you before this life insurance policy would ever presumably pay out. Do you honestly think that the insurance company is still going to be around? Do you think that there's going to be a rule of law to enforce all of this? If I was in that position, I would say cash out of that insurance policy, pay off whatever debt that you have, get as completely detached from this bubble, this horrific bubble of a system, and get that money out now, because the assumption that that the insurance company is even going to exist and that you're going to be able to collect on any of that is specious at best.